The market is in quite a tough place here, and if you ask my opinion, as I've been signifying in my model last Friday, I've been saying we are guys gonna enter the downtrend. We're gonna enter the ABC correction. We might have the spike in a wave B up, but then we're gonna still, in my opinion, continue heading lower. So in today's video, I wanted to emphasize what is painful for an investor is the paradise for a scalper. And today is one of the most important fundamental videos I've ever done, where I'm gonna emphasize how to take advantage with an option trading of the current conditions we have right now. So please stay tuned. All right, good morning, good afternoon, everyone. My name is Ross. Today is Friday, and I decided to concentrate on the fundamental knowledge today. One of those videos that I would really like you to ask, to repost, to comment, because this is not an information everyone gonna give you. This is unfortunately something that majority of traders, especially if they're coming from the world of futures or of Forex, have absolutely no clue about. And I'd like to share this knowledge with you. Basically, today we're gonna speak about the wheel strategy and about two most fruitful and simple at the same time option strategies that I already shared with my Telegram alert group subscribers. For those who've been following me in our Telegram alert group, which is actually absolutely free for the newsletter subscribers, we're talking here about less than $30 a month. So for those who is not yet there, I of course share all my trades live, which is not the case on YouTube. Gonna post a link in the description down below if you would like to join and check it out. If not, is absolutely fine. You still would get my vision, my knowledge, but like maybe in a little bit more delayed way here on YouTube. Coming back to the point, what the institutions, what the hedge funds, what the smart market players are doing, they are not buying at the market. They're using the options in order to exercise the assignments very often. We already heard of those in our Telegram group when my European users, my European subscribers were asking, how can I buy this ETF if it's not available? I said, this is not a problem. You can sell one cash secured put and wait for assignment. And today we're gonna go deep dive in, actually explain how to pick up the strike price, how to pick up the particular date of that assignment. And with all that said, let's go. Before we dive into the option chains, I propose us to focus on one particular chart for today, on one particular stock. It's super important for this strategy to pick up the stock that you actually want to own. Don't pick up, please, something extremely volatile, micro caps or companies that are the next future 100x players. Don't do those strategy on psychedelic stocks, not because they're not good, but because the option chain would not have the required volume and would have too high of the spreads. I propose that we use today Tesla because this is the company, despite being in Mag 7, has one of the highest implied volatilities on the market. Here today, I'm not going to cover entire theory, what is call and what is put. I moreover think there is a lot of content of those in Investopedia, in other YouTube videos. What we're gonna do here today is make sense out of the theoretical content with Black-Scholes and all the formulas in a practical terms. Okay, how can I make money on that actually? So I'm not gonna speak today that the call is the right to buy a certain thing at a certain price. Just to briefly emphasize, call, you buy call when you're bullish because you think price is gonna go up. You buy put when you're bearish, you think the price is gonna go down. Now, that we only spoke about buying, you have another way of dealing with things is writing off or selling. You are selling call contract, call option when you think price would go down, and vice versa. You are selling put if you expect price to go up. Let's put it in a simple table. This is exactly something I've been emphasizing right now. Simple, long call, buying call, price would go up, buying put, price would go down. Then you have selling options. You're selling the call when you expect price to either stay at the same level where it is right now or drop down, and the same with selling puts. Price will stay where it is if you are actually above the option strike price or raise. So let's start from there. The strategy which we're going to start with is called the CSP, or cash secured put. Looking at the chart of Tesla, I see that the company has been already down roughly 32% within the matter of 2 weeks. And what does it mean when the price of the shares is going down? Obviously, the put prices are going up. The put prices have been going up all of that time because we had a bearish move. So while I'm here, I might want to say, damn, I actually think Tesla has a severe drop. I want to own this company into 5 years from now with the self-driving cars, with all the technologies. This company is clearly more than just a car manufacturer. So I want to have Tesla into 2030. Fine. How do you get assigned? Of course, after such a severe drop, you can just say, oh, I'm going to buy Tesla. It's at $201.88 per market. I'm just going to buy. Or the second thing you can do, once the stock market is open, New York Stock Exchange has to open. So it has to be from 9:30 a.m. Eastern time until 4 p.m. That's the only time that option chain is open. You cannot do it in after hours. You cannot do it pre-market. So you have to wait and sell the cash secured put. This cash secured put, we're going to go in the options chain in a second, has two parameters. One of them is the strike price. This is the strike price in dollars. And another one is expiration. And this expiration is normally the time. Those are two parameters you kind of need to decide. So I'm going to go right now into the option chain, and I do it on purpose in the broker neutral website, Market Chameleon, for example. Market Chameleon has all the information about the options. You don't need so much for today. We're only going to see here at the left, and first of all, select the expiration. You can see that there's dates on the left. You can have an expiration as early as of today. And that's when you really want just to get assigned. You think the price would go up and there is no way to wait, and you're a European customer and you cannot just go and buy, for example, this S&P 500 ETF for American users. So you just want to get assigned as soon as possible. But right now we're going to follow a different strategy. We actually want to make money. We want to make money out of theta decay or out of time component through which options are going to get cheaper through expiration. And one important thing, guys, I want to emphasize here, it's also very important thing for me to mention. We are now living in a world of modern monetary policy, modern monetary theory. There are a bunch of derivatives. There are a quadrillion, it's like a million, billion of derivatives that are available in the market. It's a question, of course, which of them are options, which of them are futures. It's a bit hard to estimate directly, but think of one thing. 80% of options here are expiring worthless. They are expiring worthless exactly because of this theta decay that I mentioned. Coming closer to the time, they are far away from their strike price and their value is close to zero. So being on the side of the market maker and being able to sell the option to someone, something that will expire later, worthless, you can come back and buy at 1 cent just to close your position, to make sure that transaction is executed. I actually recommend not to wait until the very, very, very second of an expiration. I recommend to close it a day or two at least before, right? To avoid an intermediate assignment or any other, black swan event that can happen when, for example, you were 99% plus in your position, you sold something that expired near worthless, and then boom, implied volatility hit in, and you actually lost a lot of money. So we're going to close them eventually. But what's important, that you want to write off the options. You want to be a short seller of those options because you want to sell something that later on would expire worthless. That was just a little short theory why we are actually selling the things. And when we are looking back into those table on the left, so we see various dates. We can see those dates in 2024. Those dates can even go as far as 2026. So two things I want to emphasize here. First of all, you are looking at the implied volatility. Implied volatility is a measure, and this measure is actually emphasizing how much more options, simply put, are more expensive comparing to the stock prices. So you want the implied volatility to be as high as possible if you are selling the options. And this is the reason option sellers love Tesla so much more, because on one hand, this is the Mag 7 company with the clear product revenues, not something ephemeral. On the other hand, Apple, Google, Microsoft, their price fluctuations are so low comparing to Tesla that their implied volatility would only be 20%, 25%, sometimes as low as 12%. While Tesla offers, while being multi-trillion-dollar company, offers you such an expensive option chain. So that's very lucrative to sell, and that's also the reason why we are looking at Tesla today. And the second thing I need to emphasize here, that with cash secured put strategy, if you have selected the strike price, which is below the current price, but prices keep dropping, and your assignment is about to happen in November, of course you can get assigned. But there is always a second option. You can roll over your put contract into the future, close this current one in November, and sell the new one into February. So you would expect this price to slowly find its bottom and then bounce back. So there is always an opportunity with the cash secured puts and with any other options, of course, too. But we know we are in a market that prices normally tend to gravitate up, right? So we want to be longer in time in a long position. We don't want to be longer in time in a short position. We don't want to open the short for NASDAQ and wait 10 years from here, right? This is not what you do. You normally open short positions for the short amount of time in the market where governments are debating the currencies and governments are basically inflating all the prices available. This is why selling cash secured put, I recommend to stick to the period of time, which is 2-3 months from now, sometimes 6 months from now, where the bid and ask are very close to each other, so you would not lose too much money from selling something and then buying it back. I want it to be, let's say, $0.50, $1, sometimes a few cents if possible. I don't want that to be a huge amount of money because one option contract is representing 100 shares. And so to sell one cash secured put contract for Tesla would already, with the current price of Tesla, where we are right now, roughly at $200. So you would need to understand $201 multiplied on 100. We're talking here about basically allocating roughly 20K of your account into this one particular contract. Now, what is important to mention, for example, Interactive Brokers is not locking up the entire $20,000 from your account. You can actually, even out of $20,000 account, if you only have $20,000 liquid, you can still trade 3 or 4 or 5 contracts. Because Tesla is the blue chip stock, and also Interactive Brokers knows it's unlikely that Tesla would go down from $200 all the way to $25. It's not going to happen. It can go down maybe $30, maybe $40, but you are still able to get assigned and to buy your Tesla, having larger position than your account size if you have a margin account. This is very important what I'm saying right now to calculate your returns, because very often you can make a very significant amount of returns just within 1 month, but I also do not want, of course, to recommend you to go on margin. This is just something that you have a margin account you need to be aware of. The system, the broker, would allow you to sell more, but it doesn't mean that you have to sell more. But coming back to the chart, one of the potential scenarios you might think, and this is something that I personally think myself too, we might bounce back, take the liquidity from those gaps. And then I think, S&P 500 and NASDAQ are not yet done. We're still in a downtrend. So you might expect something like that from Tesla and potentially a reversal. So what you can do, you would say, wow, I'd like to sell the cash secured put with a strike price to be conservative, let's say 165. Yeah. So 165 is somewhere here. And I give that move, let's say this downtrend move, we are now in August, September, October, November. I give it 3 months from now to resolve. And I bet that by the certain day in November, we're going to see which days in November are available in option chain right now. But a certain day in November, Tesla would be above $165. What does that mean in practical terms? Let's look in a market chameleon. For Tesla to be in November, so we have 15th of November here. I like this date because implied volatility is the highest among all. So that's good because we're going to sell put on the highest price possible among other dates. I'm clicking here and now I see on the right part of my screen, puts are always normally on the right and calls are normally on the left. Calls are not interesting for us right now. I am seeing at 165. I see the bid 915 and the ask of 925. So what does it mean in practical terms? We are coming back to the chart and I'm gonna explain to you. So you remember this number 915. It means that there are two outcomes we can face. The outcome number one, by this date in November, or you don't have to wait until the end of the date. You can also, you close your contract anytime before. If you are in profit, that's all fine. But we say by the date in November, if Tesla is above $165, then you just take $9.15 per share in your pocket, and that you make money. But $9.15, that's per one share. And remember, option contract is for 100 shares. So we're talking here about almost $1,000, or to be precise, $915 that you're going to put in your pocket. The option number two, imagine Tesla drops even further. And yeah, you were, let's say, a little bit greedy. And by this expiration time, Tesla is actually trading at $150. This is not so good. It's 150. What happens in this case? Well, then you get assignment. I mark it with the letter A, English. And in this case, you are forced to buy. You are forced to buy at the strike price you have been choosing at 165. Really? Not exactly, because you still collect the premium. You still collect your 915 for which you sold option today and the 9th of August in summer. So what does that mean? 165 minus 915? It means you own the Tesla at $155.85. Considering where the price is right now, is it a bad deal? No, I don't think it's a bad deal. Considering where you want this company to be in 3 years, maybe at 300, maybe at 400, maybe at 450, we don't know. Is it a bad deal? No, it's not a bad deal. So why is not everyone using it? Well, a lot of people, first of all, are not aware about it. A lot of people also find it too complicated. This is the reason why I wanted to make this video to explain. And now, guys, from here, you are actually owning 100 shares of Tesla. What can you do from here to protect your stock? Now you have 100 Teslas. You can make money on the opposite direction, selling the covered calls. It's another strategy. It's another simple yet powerful strategy when you are expecting price to stay in the range. Remember our table from the beginning of the video, to stay where it is or even to drop further. Imagine you are assigned with this Tesla shares and you're thinking, down, we're going into election, we might have some volatility, might have some geopolitical risks. How do I make money while not losing my Tesla? This is another very lucrative strategy. This is something I recommend everyone to use, especially if you're not too greedy, if you're choosing your strike price for the calls well high above, because the outcome, if you are choosing that strike price too low, that you would be taking your shares. It's like someone would take your shares from you because you sold him a right to buy Tesla, let's say at $200, and now Tesla is at $205, right? But you sold this covered calls. So now he can come to you and say, hey, I want my Tesla at 200 because I own those call options, and there it's at 205. So you have to sell it to him below the market. Would you also collect the premium like in the previous case? Yes. So effectively, you would not sell it straight at 200. You would sell it at 200 plus a little premium that he collected on top, like maybe another $3.5. So you would effectively sell it at 203.5. Yes, you would lose your shares, but keep in mind, you got assigned to Tesla at 155 something, and you sell it at 203. So you make good money. And we're talking here about half a year. You still made your, 20% on put, another 30% on call. You made great money, mate. So that's nothing to regret. Now you can also take that money and buy Intel or buy PayPal or buy anything else that you believe right now is providing you a better value in the market. So there's no need only to be all your entire life in Tesla. But of course, if you want to own Tesla 5 years from now, be very careful with selling the the covered calls. Yeah, be very careful with selling the covered calls, because covered calls can lead you to lose your favorite shares. Now let's look in the market chameleon and see what would that mean for Tesla in terms of the prices. So we are coming back to the table, and let's say we've been assigned in November, and we look now at January 2025. Of course, I also would like, here to take implied volatility also high, because we are still selling things, right? So calls and puts are both worth to be sold when implied volatility is high. And of course, this is just for demonstration purposes, because price in November would not be where it is right now, but let's assume price of Tesla stays the same. Let's assume actually Tesla is still around $200 as it is today, and you want to sell the calls at 220. So selling the calls are here on the left at 220 strike price into January is gonna bring you $22.20 per contract. Or keeping in mind that we're dealing here with 100 shares, $2,200.20. And what is particularly good about that strategy? That just waiting for 2 months from November into January, the Tesla that you owned, either buying it straight from the market for $20,000 for 100 contracts, or for being assigned and maybe paying $16,000 to own 100 Teslas, you are getting paid another $2,200 just for 2 months of the Tesla price not going above a particular strike price. So in the first case, your cost of ownership went down from 20,000 to 18,000, roughly. In the second case, your cost of ownership went from 16,000 or 15,000 down to 13,000. And now you can do the strategy again in another 2 months. So effectively, you, in a matter of a couple years, would reduce your cost of ownership to some particular very funny, very, very low value, sometimes as low as $50 or $30. If you're really like a very aggressive trader and you're good in it, you can also, after a certain amount of time, make sure that you owned that stock for free. Yes, you heard it right. Through selling something that is expiring worthless in a certain amount of time for a period of time, for a period of years, you can sometimes reduce your cost of ownership of the blue chip company that you believe in all the way close to zero. I'm not, of course, encouraging you, to go right now and to get aggressive, because it's very likely that you're going to lose your shares. But at the same time, if you're playing it right, you're also going to lose your shares at a premium. Yeah, so you're also going to make money. And that's why this strategy is so lucrative, because you can play it in a form of a wheel. And that's why it is actually called the wheel strategy. And this is what exactly I meant. We start here from the top. We are selling puts. And if assigned, we start owning the shares. So we are selling calls. And if assigned, our stocks get called away, but we make money. We make much more money. We made money here. We made money here. Now we have more money. And here we restart. So we might go also to another stock. Now we can go to Intel. Let's have a quick look in the Intel so you would understand why I actually has chosen Tesla in the very beginning. First of all, let's look at the Intel chart. If you remember, Intel has a severe drop. It looks quite interesting here after that correction. So this correction, the gap itself is roughly 28%, and we drop all the way almost 40% from this order block, or if we measure actually from this recent top that was just 10 days ago, almost 50%, guys, 49%. This is a severe drop. So let's come back to the option chain and see if it's actually lucrative or not. I'm typing here INTC, or you can just write Intel, the system would understand. And here on the left, you are clicking on the options and you're clicking on the option chain. So here you see, wow, because Intel actually has been quite volatile in the aforementioned drop, market participants starting to price options much more expensive because they don't really know what's going to happen to that stock. This stock acts like crazy, and that's why the ATM at the moment, implied volatility, is above 50 for the month of November. So let's click here on November and let's see what are the strikes we have. Obviously, Intel is much cheaper as a share. It's 10 times cheaper than Tesla. We're talking here about $20 instead of $200. Hence, the premiums for the options are also roughly, 10 times lower. Of course, there are many more factors that are affecting those option prices. They are called Greeks, and this is like the topic for another 5 videos. What's delta, what's theta, and so on and so forth. But for now, let's just stick to the simple, practical ways of making money. So if we are right now at $20.38 for one share of Intel, where I see the money opportunity, well, imagine we are gonna sell it into November at 19. So in this case, our cost of assignment would not be 19, it would be 19 minus 134, would actually be below $18. It's gonna be 17.66. It's good. 17.66. Now let's look at the chart. do I want to own Intel, especially taking into account the efforts and some AI acquisitions and so on. 1766, it's here. It can actually mean that the price would never come back here, but we might still either collect the premium, or if it goes down below, we might get assigned at that price. And so you kind of like diversifying your risk a little bit. Yeah, also, of course, Intel can also go down for $14, but what's the probability of that after such a severe drop? I don't even want to go into, TDIGM and like see how deeply oversold we are on every time frame, with RSI below 20, fine, that's what I mean. I think, you shouldn't also be too greedy here. If you don't think this company would go bankrupt, you might want to get a sign on this price. And coming back to Market Chameleon, I also wanted to emphasize to you why I picked up Intel here. Because if I go and look into something like Apple, of course, Apple also have a huge moves right now. But if I, once again, click here, options chain, I look at implied volatility across different periods of time, then I see that Apple only has a 26 implied volatility. So for something that costs almost as much as Tesla, I go to also, let's say, January, February, doesn't have February, so it can be January. We are talking here about quite a different premiums. You see, those premiums are almost like half the premiums of Tesla. So that's why it is not as lucrative for me to actually play the wheel strategy on Apple as it is to play the wheel strategy on Intel or on Tesla. Of course, you can also put here some, penny stock or some smaller stock, like, for example, Atai, our psychedelic pick, right? And you would say, Russ, let's trade that. It has an implied volatility of 168. That should be so lucrative. And I would tell you, no, guys, I don't think it's actually going to be very lucrative because, looking here at the spreads, I see the bid is 20 cents, the ask is 95. So yeah, you're going to sell it at 20 and then you have to buy it back. Of course, with a period of time, you can just wait for those to expire worthless, but it's not something you want to play. Like, those are not really something you want to get involved. This $1 spread between the bid and ask, this is a no-go. You only have to play that strategy on the liquid instruments, and you only have to do it on the stocks that you are very sure in 5 years from now, in case you're assigned, you're happy to hold and you're happy to collect the premium from selling the call options, right? You don't know what's going to happen with a small company 5 years from now. Maybe it's going to go bankrupt. So you're basically going to lose all the money in your share. So yes, please, extremely important, only play it with the very, very top list of S&P 500. You can do it, as I said, you can do it with Microsoft, with Apple, any company that you believe in long-term from here. I, for example, believe in PayPal. I'm not recommending it to anyone, but I can also play that strategy with PayPal. I think people have seen, we've been selling cash-secured puts to get a sign on PayPal. Guys, TLT, imagining TLT as an example, the 20-year bond ETF. So you can actually get assigned to TLT below the market, and then for owning TLT, you're going to collect the payout that TLT pays, 3.8% every month. And plus, you can collect the premium from selling the covered calls. Of course, TLT is extremely low volatility stock, so please don't expect the implied volatility on TLT to be 50. No, it's going to be 11%. It's going to be 12%. So it's not going to be much, but it is an extra payout. Imagine you hold it 5 years from now, it's an extra few percent of payout. So instead of collecting 4%, you're actually collecting 8%. So you can also like double your yield. But be careful, because those things, such as selling covered calls, can also, if stock price goes very quickly up, you would lose your TLT, for example, at 110 minus the premium you collect, or plus the premium you collect in this case, at 112, and then the stock would be at 120, and like, damn, I lost actually more gains for doing nothing, comparing to playing all this, risky strategies. So yeah, of course, if that would be so straightforward and so simple, then everyone will be a multimillionaire. So you also have to use your brain and to be smart with the charts and with options chains. With all that said, guys, I wish that video gave you a good knowledge for today. It might require you to watch it a couple of times because it's not straightforward. Please don't be tough on yourself. It takes people months and months to learn options. I personally know many traders who are more than 10 years full-time trading. They don't understand options. It is absolutely fine. Majority of people have very, very poor understanding of options, just at the level of, okay, this is call, this is put, but what I do with those, I have no idea. Normally they just buy calls when they think price is going to go up, and then what happens? Their calls are expiring worthless because the price actually doesn't move within the next 2 months. So there, yeah. Or they buy put to protect the market, protect themselves from the market crash, and then market is actually, it is chopping for a month, and then your put is worthless. So they'll just lose money. With that strategy that I actually gave to you, with a wheel strategy, with a short strategy, you don't lose the money. In a worst case scenario, you get assigned a blue chip stock. So this strategy is much more safe, much more secure, is much more capital protection friendly. And with all that said, I wish you an amazing end of the week. Sending you much love, and please be well. Ciao.